What's up, guys? Welcome back to another episode of Blondes Building Equity. This is our 5th episode. We are really on
I know, I'm so excited.
And we have a really special guest today. His name is Mikey Taylor. He is incredible, and I'm so excited for you guys to get the opportunity to learn from him today. I'm so excited to learn from him today. So go ahead and introduce yourself, Mikey, and give him a little 411 on who you are.
Okay, thank you for having me, first off. Little 411 on me. So my first career, I was actually a pro skateboarder. I was a pro skateboarder for about 14 years, which was amazing because my passion turned into a career. The hard part about it was I picked a career that had a very short timeline. So I was always trying to figure out what was to come next. My first kind of exploration outside of skateboarding was actually in the craft beer industry. And me and two of my close friends started a craft brewery in San Diego called St. Archer. And we had a lot of success with the brand. It very quickly became one of the fastest growing breweries in California. We ended up selling our company to Miller Coors in 2015. And then from there, I started my current business, which is a private equity real estate firm. Our company is called Commune Capital. And we have 3 different platforms, one in the storage space, one in multifamily apartments, and then we have a lending business on commercial real estate. And then we use social media to basically create financial education content to hopefully educate our audience and pick up in a way where the school kind of neglected to. And that's where we are today. That's the last 20 years of my life.
Wow, 20 years. So how old are you now?
39.
39. Okay. But I can relate to a lot on I've been in social media now for years, and it's really a short-lived career. And that's kind of what was my segue into real estate as well, was realizing, okay, now I built this business and this brand was able to monetize, and now what can I build wealth with? You know, that's going to be able to, like, I can have forever and have some security, because it was always that fear in the back of my head, like, okay, things are going really well right now, but I don't know when that's going to end. And that was really, really scary. So I can definitely relate to you on that. So what was kind of your first real estate move or real estate
play?
I
was going to say, what was like your first introduction to real estate? Is it just like, was it the money that enticed you? Like having like passive income? Like what was it?
Yeah, it's such a good question. So when I first started investing in real estate, I didn't even know what passive income was. What I could tell you is back then, I felt like my sponsors owned the control of my future. And I was desperately trying to take as much control from them as possible. And I had a friend who kind of understood that. So he brought a storage unit opportunity to me. And basically what he said, he's like, look, this is what we do. We look for basically vacant buildings and we try to buy them at a discount and then fill them with storage units. And I was like, okay, cool. That sounds awesome. How does it work? And he basically began to tell me, well, look, we bring investor dollars in. We then do all of the work. Then we fill the storage units until the property's stabilized. And then it basically pays our expenses, it pays our debt, and then it pays our investors. So for you would be an investor and that money would pay you. I believe they paid out quarterly. That money would come to you quarterly. And I was like, okay, that sounds cool, but that kind of sounds crazy. And I wasn't totally sure that it worked. And then when those checks started coming in quarterly, that was like the aha moment for me, where I was like, oh my gosh, this is how I take control. I just need as much income as I possibly can get so that it offsets the income coming from my sponsors, and then I am good. And that was basically my plan until I started my first company. It was just be broke and put as many dollars into real estate as possible.
So what were the returns? Because I think that's, because we're doing a flip right now, and a lot of people are kind of confused on what returns you can expect when you're investing into real estate, you know, when you're an investor, like an outsider investor. So what type of returns are you looking at?
Yeah, it's a really good question. So first off, you separate whether you're going to invest actively or passively, right? For this conversation, just because I was a passive investor, let's keep it on passive. You then have to basically separate what type of passive investing you're going to do. Like you guys brought up a flip, right? A flip is quicker turnaround of money. And in some regards, you're taking on greater risk. And because you're taking on that greater risk, you in theory should see a greater return, right? And then when you move over to long-term investing, there's even different risks inside long-term, right? You can buy a stabilized building that cash flows, you put long-term debt on it. That's a safer type of investment. you're going to get a smaller return from that. So where I sat in that kind of, let's call it risk reward metric, I was investing in a long-term asset, but had a little bit more risk because they were taking an asset that didn't generate income and were building it to generate income. So at that time, basically what they were targeting was about a 15% IRR. And IRR basically just calculates time into the equation. So on a 15% IRR, you're basically doubling your money every 5 years. And then that's a blend between the cash flow that you have coming in and then any of the appreciation along the way. So it's taking all of the return you make and then calculating that into time.
Wow, amazing. Yeah, I think you do take on a greater risk, but what we've kind of seen with a little bit of investors is like the illiquidity kind of makes them nervous about a long-term hold, especially because it is a passive thing. Like us as real estate investors, we love the idea of a long-term investment that we know we're not only building passive income, but we're building equity. But with these other investors that are doing it very passively, they're doing it passively because this isn't their, full-time job. Yeah. So that's why they do it passively. So they don't really understand it. So for them thinking like, wait, you're going to have my money for how long? And I can't pull for 5 years. Versus now we've been able to a little bit easier to raise money and say, you know what, we're going to be out of this flip in 6 months. We can pay you out, or you can roll over your money into the next one and continue your returns.
Right. And it's really important to note that we're talking about risk through the lens of real estate. Real estate has a totally different risk profile, whatever you're doing, compared to something like the stock market or other things. So when we talk about risk, this is already a risk-adjusted return because we're investing in real estate. And then there's those different variances in real estate. So, and to your point, 100%. A 5-year investment, a 10-year investment, that's a very illiquid investment, 100%.
Yeah, and with us, we target like kind of our investors have been a younger crowd because it is a lot of our friends who have been fortunate enough to make money maybe in social media or as a professional athlete or things like that. So they're not like, accredited investors that are used to a long-term play on investments. So they're like really scared about the idea of a really long-term hold, but we're like, no, that builds equity and passive income. So right now, with our flips, it's worked great. So how do you typically raise funds? Is it all through social media, through accredited investors?
Yeah, really good question. So we can only accept accredited investors because we market our opportunity. And I do it through multiple different facets, I guess. I have like my circle of whatever you want to call it, influence, or my network. And I go out to them with opportunity. And then we use social media to also create opportunity. And I would say we're probably at maybe a 60-40 blend where 60% still comes in from like our actual network. And then maybe about 40% from social.
But it's all accredited investors.
Right now, we can only accept accredited. Yeah, we're working on something where we can market an opportunity and it's for non-accred. We're in the final stage with our attorneys. Then it'll go through the SEC approval process, and then we'll see where we land.
So for people that don't know, what are the requirements for an accredited investor? How much do you have to make? What's the process like? What's the application like?
Yes. So basically, the SEC puts a benchmark on who can and can't invest into private offerings. Why they do that, that's debatable. But let's just say they do it because they think they're trying to protect really good marketers from taking money and putting it into an illiquid investment, whatever. So basically what the SEC says is if you make $200,000 a year from income for 2 years as a single person, or if you're married and make collectively $300,000 a year for 2 years, or you have a net worth over $1 million excluding your primary residence, that qualifies you as an accredited investor. And basically what they say...
There's no application or anything?
You have to have either a CPA sign off for you, or you can go to like a third-party service that qualifies you. But for our offering, when we pitch it, the investor has to go through a qualification process, and then it shows up to us that they are qualified, and then we can bring them in.
Got it. Okay, that makes sense.
Now, you said you have the 3 forms of real estate that you're doing. Now, throughout your 20 years journey, which one would you say, if you had to start all over from the beginning, what would you do?
Oh, that's a hard one. Storage has been so good to me. It's like storage is one of those things. It's a boring business. It's not very sexy. It's a cash cow. it's done well. But I like multifamily a little bit more. It has nothing to do with the return though. For me, like coming from skateboarding, and this probably resonates with you guys because of what you guys do, but skateboarding is very creative. It's anyone can stand on a skateboard and do a trick, but how you do the trick is everything. And with storage, there's not much creativity that you can put into it. You're building garages, right? Where with apartments, you're building somebody's home. You're building the place where they live. You're building an experience. You can get so much more creative on that process. So I kind of enjoy that, but it has nothing to do with return. It's just more, I think it fits my interests a little bit more.
And I think that's so important. And a lot of people ask us now why we fix and flip over long-term hold. And we're both 25 and we love the process. And it's also very, it is more of the sexy, like the before and afters. Our audience loves it. It's really part of it for us. And then to be able to really build the liquidity, build the relationship with our investors. And then once we're like, okay, we don't want to be as hands-on, let's move to something that's going to be just cash flowing and really passive. But right now it is fun for us. It is, I think we would have a little less fun with multifamily than we do with our before and after and getting to the
or
interior
storage.
design.
I don't think I would ever do, storage. Come check out our storage, guys.
You never know, but cool.
In the long term speaking, I think like getting into boring is always better. Like simple is always better. But I think in the beginning, like you kind of need something to keep you going, like something exciting. And the flips for us have been really exciting.
I couldn't agree more. I have a friend who's 25 years old that's all hot on laundromats. Loves them. So stoked on them. And I'm like, gosh, I thought storage was boring. That seems like extra boring, and he's so into it. So I think you find the thing that drives you.
What does he do? So he leases the space or he buys space?
So this kid, his name's Blake. He's a monster. He's 25 years old. I probably shouldn't say this, but whatever. I think he made about $6 million last year. And he basically lives with his parents still. And he's really big in like the Discord community. So he builds Discords around like, how to invest in Airbnb. He's really big on like Airbnb arbitrage, and he takes all that money and then he's trying to stick it in more kind of passive cash cows, and he just got hot on laundromats. I mean, as you guys are experiencing, and anybody listening is gonna experience, in real estate, there are so many ways to make money, which is cool, but it could also be a challenge, right? Like you can definitely get stuck in the chase the shiny object kind of struggle and think you could do it all, but the cool thing is there are a lot of different options.
Yeah.
And if you're giving advice to someone that's first starting out, would you say to choose numbers or passion? The revenue or the passion?
Yeah, that's so good. If you're anything like me, let's go there. If I'm into something, I'm really, really good at it. Like there's not a doubt in my mind that I'm not gonna succeed, but I have to be into it. If I'm not into it, do not count on me for anything. I am lazy, irresponsible, you'll get no output, I suck all the way. So if you're like me, you do the thing that you're interested in. Find the passion and then figure out how to maximize the passion from an income standpoint. Now, if you have a gift, it doesn't matter. You can put energy out to make money, then pick the one that makes money. It's just find what works for you. But for you guys, I'm gonna assume that like, I couldn't just say, hey, there's an opportunity here with like men's hair regrowth. And the business is blowing up. You can make so much money into it. You guys should go do that. You're probably looking at me and go, guys, I have no interest in like helping men like get their hairline back.
Yeah, we've been there. A lot of different businesses and like 5 each. And it's at the point where it's like, we just looked at each other one day and we're like, why don't we just do what we're passionate about? Like we're good at anything we do. We're good at anything we set our mind to, but the drive that we have for something, it only lasts so long if we're not actually passionate about it. So we might as well just actually do something we're passionate about to like stay in the game long term.
And to be able to build a long-term business. And that's where we go back and forth. And we've seen so many other real estate investors. You're so right about, there's so many, it's like saying you're a teacher, but like, oh, are you a chemistry teacher or a bio? Like there's so many different niches inside of real estate that gets confusing sometimes, because even us as, fix and flippers, we're like, oh, okay, but we want to go buy this apartment complex. It's a whole new learning field. It's a whole new learning curve to understand. You can't just jump in, and it's very different. different. So you kind of want to be a master at one of those
Yeah.
things and not just keep running around. So, I mean, obviously we want to evolve from fix and flipping to long-term hold, but it is always enticing, like running in different directions, even in real estate. So I think it's important to kind of find your niche in real estate so that you're the best at that, because there's a lot of investors and you're always competing against, you know, really, really intelligent people. So you kind of got to be the best at your one niche.
And I have another really great question. Something that we're struggling with because we're a newer business is building a really talented team. Because we in our own right are like, when we set our mind to something, we're both those type of people that just excel because we set our mind to it and figure out the ins and outs and really study what we're doing. But it's hard to find talent like that to work for you and kind of like offset the workload so that we can get more fix and flips and we don't have to be so focused on the one that we have. So how did you go about acquiring like talent to work for your team?
Are you having a hard time just finding the talent in general, or are you having a hard time finding good talent with limited cash during the startup phase? Does that make sense?
Yeah, I would say good talent in general.
Like we'd be willing to pay for good people.
Yeah.
So right now is the hardest time I have ever seen ever to find talent. It's hard right now. It's kind of a little bit concerning. We're struggling with that too, to tell you the truth. It's not easy. So basically what we have about maybe 14 people on our actual company. And then when we do deals, you know, you have the pyramid of help along the way, right? Your GC and all the people that come in. But for our 14, it took us time to get here. We're looking for people right now. We're trying to fill about 4 positions. It's not easy. I'm doing it through a function of, I put it out on social media. I reach out to people. We use some of the, they're not brokers, but what are they when they help source? Head hunters, right. And then basically we just interview like crazy and we take our time. You know, it's one of those things where it's like, it's just hard to frickin' find them. And I don't have a solution yet. We're kind of exhausting all of our options to find right now. Hard talent is hard to find right now. And you're going to hear that. No, you're going to hear that with every company right now. We have an abundance of job openings right now and people aren't taking them. And so it makes it hard to find talent.
Wow. Yeah. Super. Okay. That makes us feel better because it's been definitely a process, and also us we have to formulating those systems in our business to make things like be able to hand them off, because we still like need control over everything because we don't trust those people and we haven't built that solid team. And we just know how much scale once that happens. But
even like ordering materials for our project, like little things, we're kind of micromanaging because we're like, well, we don't want to get overcharged. We want to make sure the design is good, but also the price is good. And like the landscaping and everything that you would kind of offset to like either a project manager or a general contractor, which we have both, we are still micromanaging because we're like, oh, we can find better, we can do better. And then we do. And we're like, God, how do we train them? Like, how do you find someone that the mind that we have?
Okay, so those, in my perspective, are almost like 2 different challenges, right? Like we're having a challenge right now just with finding good people, but I think what you're describing is the challenge of letting go of control in a sense, which allows you to scale, but also puts you in a potential of it not working out as good as you think you can get it done yourself. Right? That is an entrepreneurial struggle that for all of us, that's a hard one, right? But on the first part on finding people, I think, if this thing keeps kind of materializing into an economic downturn, I think you're going to see a lot of those job openings compress. And in that compression, in theory, there should be more people looking for jobs to fill. And maybe that makes it so we can find more talent. That's kind of TBD. The control or the micromanaging one, I understand that one. That was something that was really, really hard for me to learn. For me personally, I had to let go of the idea that I could be the best at it, at finding the best price. And I needed to start looking at it through the lens of how do I get to where I want to go faster? And how do I free up more of my time? And so in the beginning, I would put people in place. And there was a moment where I thought I could do better. And then before you know it, they were doing it better than I could. And then the whole group started moving forward. So that was just a control thing I had to work on,
So I guess what you're saying is maybe we need to allow them to have a little bit more control and maybe like mess up a few times in order for them to learn and get on that level that we want them to be on.
Have you heard of the 4 different cycles of entrepreneur? Did Brandon Turner tell you about this?
No,
but he did say, which is really relevant to this, he said who, not how. He read this book that he recommended to us, that he said, instead of figuring out sometimes how I can do this, you hire who can do this. So it's kind of a little bit, but I would love to hear your...
So I was with Brandon when Brandon brought you up and was like, you have to meet this girl. She's amazing. And he was speaking on stage at a storage conference in Idaho. And he was going over the 4 different entrepreneurial mindsets. And I had never heard this. And he was saying how the first one is the DIY entrepreneur or the solopreneur. And they're used to, I got this, I'm gonna do it all, I'm gonna outgrind everybody, and I can earn a lot, but it's kind of as much as you can do is as much as you get to accomplish, right? Then you have project manager entrepreneur, where like you're really good at managing your group, and then that group allows you to scale to a certain point. Then you have COO type of entrepreneur, where you can, oversee 4, and then that 4 oversees 4, and kind of more of the corporate structure brought to entrepreneur or brought to entrepreneurism. And then you have the one at the top, which is the visionary or the energy entrepreneur. And they are the ones that drive the team forward. They're the vision, but you have the whole machine doing all of the work. And so he began to say how he learned over time to become the vision. And now he has a meeting for an hour every Monday, and that is basically it. And then his whole team is out building his real estate portfolio for him, right? And I was the DIY entrepreneur. Without a shadow of a doubt, that was me. And it took me time to get to the point of going, okay, I don't need to understand everything. I don't have to have my hands in everything. I need to have the vision. I need to drive it. I need to empower the team to do. And now I'm operating in my highest calling, and my time is more available to do other things.
I love that.
Yeah.
And the points you hit about Brandon, I think we see ourselves so much being that visionary, that energy, and it's just like now going through the phases to actually get there. But it's also inspiring to hear, and that's why we've really loved doing these podcasts so much, not only for our community, but for ourselves, getting to network with you and feeling so inspired by that comment to be like, okay, this is our time. Now that we've learned these lessons from you who've gone through it, that we could skip a few years ahead, hopefully, and start that journey, because I know we could do so much more the second that we start to let ourselves expand.
1000%.
You also made, this is a good segue, because you made a good comment about, with, the market and the recession or things looming in the air, that jobs might be opening up. So how has it affected your real estate business right now? Everything going on in the market. Where do you kind of see the market heading? What's your opinion? Obviously, none of us are market makers, but how has it affected your business, and where do you kind of see it going?
That's a really good question. So you never know is kind of the answer. We don't know. We have ideas of what's going to happen, but basically how it's impacted our business is more when we're looking through or looking for deals right now, we have to stress test them. Basically, we kind of look at it through the lens of, okay, we have a deal that makes sense if most of the things go right. But what happens to this deal if things get really bad? What if interest rates run on us? What if rent growth goes away? What if occupancy becomes an issue, right? What happens if all these things play out? And then when we stress test our deal, do we still make money? And if we can still make money, then we're moving forward on the deal, but it's a lot more no's than yeses right now. But I will say this.
It's a lot more no's on your guys' behalf, you guys are saying no?
Yeah, we're saying no to 40 or 50 deals a month. And even the ones that we say yes on doesn't even mean we're getting them. So it's a little bit more work right now to, I guess in theory, control your emotions. But what I will say about this, whenever there's uncertainty, that gives you the opportunity to negotiate, right? You now have an added leverage because of this uncertainty. So it allows you to get in and negotiate a price. So don't be scared that there's concern in the air. Use that to your benefit to capture a better deal, But for you guys, if you guys are flipping and we are in the business of flipping, we would probably look at it through the lens of, okay, what am I buying it for? How much am I all in on this deal? And what's my ARV, right? We'll go real simple here. And if I'm expecting my ARV to be, let's call it $2.5 million, right? We might say, you know what? Let's expect the ARV to be 2 million. And at 2 million, do we make money? And if the answer is yes, then we probably go forward with that deal, knowing that we still might get that 2.5 or 2.4 or 2.3, right? So you're just being conservative in your underwriting and planning for things to go wrong.
Do you have a rule of thumb that you like bring it down? Because to go from 2.5 to 2, that's a lot. Like that's a huge difference. Is there like a percentage that you guys kind of take off that you expect? Like if the market drops, we're going to take it off like 20%.
Yeah, that's a really good question. So for us, our business works a little bit different than single family residence. And that like 2.5 to 2, I threw that out of my butt. So do not use that at all, right?
I'm like,
So
wow.
I don't think we're making money on that.
No. That was just let's make our point known, right? So this is how we do it. So basically our properties are valued off what's called a cap rate or a capitalization rate. And so if we're expecting cap rates to be at, let's say 5% when we're looking at selling our project, when we stress test it, we'll probably move it about 0.5%, which becomes our like base case, and then another 0.5% in a stress tested environment. So we're moving it a full percentage point, but that is location specific. And then even when we're looking at interest rates, we'll do the same. What does this thing look like if we have to add additional 3% on our interest calculation? On our budgets, maybe we'll add an additional 10 to 15% of overages. On rent growth, if we're looking at 5%, we'll look at what it looks like at flatline. So we'll kind of go through all these metrics, and all of that then changes the value of our property. Like for you guys, when we were kind of talking about ARV, that's what would bring our total value down, is those levers.
So with the percentage for interest rates, isn't it like for every percent the interest rate goes up, the real estate market goes down 10%? What's that rule?
I don't know for you guys, because single family's not in our wheelhouse, but typically what happens is cap rates and interest rates need to follow each other so that you have room to make money, right? The difference between cap rate and interest rate is your spread. So for you guys, I don't know what the percentage is, but what I think is important to do, and this is something we do on figuring out what the forward-facing numbers are going to be. We have a subscription with a company called CoStar, and CoStar gives you basically all of your metrics in certain areas. And you can also set up meetings with their economists that are forward facing, that are basically predicting the market. You can do that with brokers as well. You can talk to brokers and go, hey, what analytics do you have that might give us a forward facing outlook on values a year from now, right? And then you use that to try to base where you think you could land, and then you go forward.
So you did mention that you just threw out 5%. So ideally for your guys is like, what, for you to move forward, what is your ideal cap rate that you're looking at? I mean, I always thought of as multifamily 5% being low, but is it because you have such big deals, it's still worth that?
Like,
return?
is it like the equity build or what?
Yeah, so you're talking about 5% like on a cash return or as the cap rate?
Yes, you said 5% cap rate. So I always view that as...
Okay, so cap rates, basically, let's try to simplify this so if anybody's listening, they know what we're talking about. So in commercial real estate, the cap rate basically gives you an idea of the return you can make if you invest in the property. So if I invest in a property that has a 5% cap rate, I can expect a 5% cash on cash return each year, but it doesn't consider debt. So if you finance it, then that return can be higher, and it also doesn't include appreciation. So when we're looking at a project that's sitting at a 5 cap, let's say in California, yes, you're not expecting a ton of cash flow unless you're going to build it to a certain cap rate, but you are trying to get appreciation. You're trying to add value, and then when you sell or you pull out cash on a refi, you're getting that big bump.
Wow, amazing. So is that one of the strategies you use? We've looked into so much of the syndicating of the deals, adding value and kind of refining our investors out to hold the property. So is this something similar you do with your commercial properties?
Yeah, so basically we, like on multifamily, and I'll just talk about this newest deal because it's fresh in my head. We are closing on Friday on a warehouse that's in Ventura, California, overlooks the water. And so we buy
warehouse overlooking the water?
It's going to. So right now the warehouse doesn't, but we're going to build an apartment that then will. We're like 500 feet from the beach. So we'll come in and buy a warehouse. We will then develop it into an apartment building. So our value add is buying a warehouse at a good price, building apartments, stabilizing it, and then getting to a new valuation. And then in that valuation, if done right, we get to pull our cash out, and then we get cash flow beyond that. So gosh, if memory serves me right, we're buying the warehouse for like $6.5 million. And then the total cost to build the apartment will be about right around $35 million. And then when we're all said and done with the property, we are looking at a value somewhere around 50 plus million. So that basically value add comes from us buying the warehouse, doing all the work to building. And then that's how us and our investors make our money.
And what's kind of the timeline on that? Are you having to do a zone conversion? Like, is this a warehouse? Is this zoned for apartment complexes?
Really, really good question. That's been a 2-year process up until now.
Because I know how hard it is for us to just get a 1-story house to a 2-story. I couldn't imagine getting a warehouse to an apartment complex.
Sitting with the funds, like if you guys finance it or if you have investors, they just need to be okay with like sitting on the funds for like 2 years before you get the project going?
Yes and no, and it depends how you do it. Typically what we do is we work on all the entitlement stuff first before we bring investors in, and then we wait for it to be entitled, then bring investors in, is typically what we do. Then once the investors come in, yes, there's a time frame in which you're not making money because you're building an apartment. And then once the apartment's built, you have to lease it up. So you do go through this, let's call it 2.5 years, right? So no money for 2.5 years. What the desire is for an investor is we're building it to a higher cap rate. So we're able to get more money than the market has to offer for if we would have just bought an existing apartment building. So that's typically what you're looking for in that investor. I want more. I'm willing to wait 2 years to get it.
Right. And what kind of lending are you using for a project like this? Are you going in with all investor money? Are you using hard money? Are you using conventional big bank loans?
It's a really good question. So it's a deal by deal basis, but we'll do a construction loan on this one, and we're not there yet. So we haven't started outsourcing who that lender will be, but it's typically institutional size unless, we're looking at maybe like local lenders or local banks or something like that. Typically not hard money though.
Okay. Yeah, because carrying that interest for that long is not realistic.
Yeah, and you guys get hit high on the hard money, right? How much do you guys pay for hard money?
There's points up front, but if ideally we get, it's at 8%, but sometimes it's 10, 11, and then so it all depends on, sometimes we'll have 8, but then we can have 2 to 3 points up front.
Okay, so you got to be quick on it. With those loans, that's why you guys do deals in your 4 or 5 months, right? Just give me the money, sell it, I'm out of here.
We're out. Like this property, we could have easily added a second story and been able to sell it for $5 million, but that we would have to hold 8 months for permitting, then the build, we would have had a 2-year hold. So with our interest every day, it didn't make sense. So we're like, let's turn it in 60 days and be out. So it all just like really depends. We have to like factor in those interest rates. So it's kind of hard.
But expensive.
How are you qualifying for these? Because as young investors, that's something obviously like with our audience, we get a lot of questions about that as well, as like being in a position to be able to qualify for these type of loans does take time and, development relationship with these big banks. So what's been that process for you?
So for ours, it's a little bit different because we built a company and then I have partners in the company and then we have basically certain liquidity in the funds that help us qualify. If it was me doing this personally, I couldn't qualify for $50 million loan over and over and over, right? But what a lot of people do getting started is they'll have somebody sign on the loan and they'll give them a percentage of the deal just to sign on it. So you can use somebody who does help you qualify. They don't put any money into the deal. They just sign on it and then you're giving them a percentage to do so.
But aren't they liable though? Isn't there like, if they're signing on it, they're basically saying, I'm guaranteeing it?
A lot of times they're going to sign on the PG, but in multifamily, you can get a lot of loans that are non-recourse, which offers you some protection. But yes, you are still taking liability, but depending on the deal, think about it. If you're going to look at a deal that you think is really good and you would invest in that deal anyway, and they're like, hey, we'll give you a 1.5, all you have to do is sign. Some people, they're totally willing to do that.
Wow. It just shows too, like when we talked about earlier, the avenues with real estate, and what we've learned along this journey so far. And it's incredible.
Oh my God, yeah.
Just, you were saying you also have a lending business, but it's also cool, discovering once you build your wealth, how many opportunities there is to make money on your money. Just, hey, sign my name here. Oh, lend it out. Okay, I'm going to charge you 11% because now I'm the hard money lender. Yeah. I'm not going to do anything but sit on the beach and just take my money. You do all the hard work. So it really gives you those goals to build up to, and just shows in the beginning it's always a lot harder than once you start building. And then our ultimate goal for all of us is that we're just super liquid and we're able to make such easier money.
But it also is, I think, cool for people watching is that because there's so many different options, you really can be so creative in the way you go about borrowing money. And I think people sometimes think very straight-headed about this. They're like, oh, okay, go to the bank and I didn't get approved. Oh, shucks. It's like there's so many different avenues you can go. Like you were saying, having like a personal guarantee, someone signing for you, having a private money loan, having a hard money loan. there's so many different options. So if you are creative, you can ultimately like find a way to get money.
1000%. There's so many ways to do it. There's this guy, Pace Morby, I think is his name. His whole thing is creative financing. It's how you get into deals for no money down and use basically the owner as the bank. He's insane, and he's all about creative financing. So there's a lot of ways to do it. And I think this was a big aha moment for me. There are a lot of people out there with money, and those people with money don't always want to find opportunity. They get used to opportunity being brought to them. So if you can find opportunity, you can bring it to people who have money that are looking for opportunity. And now all of a sudden you get to participate in the wealth build before you have enough money to do it yourself. So, back to Brandon's point, the how or the who, right? How can I do this? Who can I do this with? It's everything.
And that's what we've always preached to our audience, because we have so many people just fighting us back. And even though we're young, we wanted to be real estate investors since we were 20. And it was like we wanted to get down and grind and make money because we thought we had to have money before we got started. And then now we're in a place where we were really illiquid. All of our stocks were down, our crypto's down. My other flip hasn't sold. And I was like, now it's time to get creative.
Yeah.
So it was really relatable to our audience also, because we were showing them, and we're what we realized more than anything is I wish I started 5 years ago and got creative and had because it only took us a few weeks. We're on different Facebook group pages. You realize you can get a cash loan, you can get private money lenders, hard money lenders, and there's unlimited money
and
out
investors
there.
too.
And investors, yeah.
We got an investor from her following, because I know that's not always relatable for everyone. Is they don't always have a huge following, but I don't have a huge following, and it was really just through my network within real estate, which everyone has a network that they've built. If you have this entrepreneur mindset, you probably have a network that you've built. So go into your network, and if you do the hard work and find a good deal, present it to your network. And some of them will say yes. We just got money sent to us, and I was like, that was so easy.
We're wow, okay, we're going for it. Barbara Corkin us. She's if they have money, I guarantee you they probably don't have time. So they have a business, they're busy every single day. They want to make money on their money, but they don't have time to go build a real estate empire. They've got a business to run. Yeah. So if you have the time, you go find those opportunities for those people, and they'll give you the money.
And if you don't have money, you probably have a lot of time.
Yeah, that's what she said.
That's right.
Wow.
That's absolutely right. And I'm going to give you one that was huge for me. For anyone who doesn't have an audience, if you're looking for investors, I still do this to this day. Go through your entire phone, every single person in your contact, and text them and say, hey, I got into real estate. I started doing this. Do you know anyone that would be interested to invest, right? What it ends up doing, it's freaking psycho. They go, actually, let me think about it. They may connect you with one or two people, or they're gonna go, Jess, Ken, why didn't you ask me? And now you're getting a triple whammy from every single contact you have. And then when they start thinking of you, they think of real estate, and they know you're looking for investors. So any conversation they have in the future, they will start bringing you leads, and you get to a point where you're wow, my network is so much bigger than I realized. And you don't need even 2,000 followers on Instagram or TikTok. It's it's a powerful strategy.
Most our connections, our most powerful connections aren't random followers from her Instagram. It really is the sphere of influence that we've built throughout businesses and meeting a bunch of people here in LA. So I think that should also be inspiring for other people. It is nice to have a lot of followers, but you don't have to have a lot of followers to have good connections in your sphere of influence. Hello guys, thank you so much for watching. We had an absolute blast interviewing Mikey. Unfortunately, something happened with the video and we weren't able to save the rest of it. So we just wanted to come back on here and say thank you for watching. I hope you guys learned as much as we learned. We love Mikey, and if you want to follow him, we will put his info below. Go ahead and follow him on Instagram, and all his other profiles we'll put here below. Again, thank you so much for watching, guys, and like, comment, subscribe, and always hit the bell notification to stay up to date on all things Blends Building Equity. We'll see you in the next podcast.